Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Drew Meredith, welcome to this Australian Investors Podcast 2 Cents episode.
Good to be here as always. Well prepared as always. We did shout out to Mr. Newbury, who did email me and said, I do need to prepare a bit more for these episodes. I will endeavour to do much more preparation in the future. And I think it is one of those things that you do need to respect the podcast, mate. In your defence, it's a short week. It is Wednesday when we're recording and it is Easter coming up. So I'll support you on that. But I do agree with Mr. Newbury. You could prepare a little bit more some weeks.
I will do better. We have hopefully, I don't know for sure yet, but I'm fingers crossed, we'll have a new head of operations next week at Rask. So that will lighten the load on me considerably. And my focus will just be podcasting, like this type of thing, live show. And investing. So
portfolio management. Yeah,
mate. What have you been working on?
Bit of everything. Bit worried about the price of, apart from the dad joke book, just continuing my research. Bit worried about the price of chocolate. I'm not sure if you saw that this week.
No, I did not. No.
There's lines.
It's already expensive, to be honest.
Yeah, it was very expensive. But cocoa futures, is it cocoa? Not cacao. Yeah. Hit $10,000 a ton, and it's going to flow through into high chocolate prices right ahead of Easter.
Oh, isn't that a coincidence?
Coincidence, yeah.
Yeah, big chocolate getting us again, right? So why? Do you know why prices have gone up? Or
Supply chain generally? No, I think there's a bit of, I think it's like anything, whether it's weather patterns, a lot of chocolate's grown in, or cocoa's grown in South America and similar areas. So getting more product to market and supply is always a challenge these days. But it's just showing you, maybe that will hit inflation figures at the same time. But there's always something happening, and we're not living in a basic and very still or stagnant environment. There's always pressure coming, like we saw overnight with the boat running into a bridge in Baltimore that then changes the entire transportation system in the US for a few weeks. Yeah, that was quite shocking, actually. Question for you. If you had to pick chocolate from Belgium, the UK, USA, or Australia, which one? Swiss chocolate? Isn't Swiss chocolate like a big one too?
Okay, we'll chuck Swiss in there. Where would Australia sit on like best or worst?
I really like dark chocolate. Okay. I feel like that's going to be better in Belgium. I think Australia will be ahead of the US. What was the fourth one?
UK.
Yeah, I think it's Belgium, Australia.
Oh, interesting.
Home bias.
Yep.
US, UK. Sorry, UK.
UK's at the bottom.
I think the UK might do better biscuits and kind of those things that go with tea, not necessarily chocolate.
I think the UK's well ahead of the US, yeah. I think that may be even better than Australia, to be honest with you. I just find that the US chocolate is no offense to anyone, but wow. It's kind of like the coffee culture. Maybe it's just a bit different, And
what is your favourite chocolate?
I did have Kevin Fung. He brought me some brittle. They're from See's Candy, which was incredible. We had that on the show over Christmas, and that was really, 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 really yummy. But fruit and nut chocolate for me is the way to go.
Any segue to your investment approach in brittle, coconut brittle?
There's no segue here, but that would be my favourite. What about you?
This is going to sound very Melbourne.
Okay, go for it.
There's an oat milk chocolate, like an
oat milk chocolate
you can get.
Wow.
That just turned up in our fridge one day. And it was quite delicious.
Okay, interesting.
I've lost half our audience.
Yeah. Everyone's just judging us for this. Platinum Asset Management shares plunged 21%.
You're stealing my notes as you always do.
I just read the headline there. Tell me what's happening.
Platinum Asset Management, one of the big long-term kind of leaders and founders of active global in equity investing in Australia, but kind of they're value investors, which has meant they've struggled over the last 10 or 15 years. And just overnight, they had announced that at $1.4 billion, I think they were down to about $20 billion in assets under management. So they lost a $1.4 billion client overnight. So the stocks slunk
very
quickly
this
morning. I don't think they're going to say exactly who it was, but it's been a similar story. So we've seen Magellan fall from over 100 billion to about 40 billion or 30 billion.
Yeah, just under 40.
And there's a couple of trends happening here. One is the growth in ETFs and low-cost passive investing. One is the difficulty in outperforming in global equities. And just a big move, like we see a lot of our audience, a lot of the people that come to see Waddle are very much leaning towards a passive core. Another challenge there is the cost of Platinum and Magellan and other, not just those two, but other active managers that institutions are internalizing a lot, where a lot of them would have invested with these groups for a long period of time.
So let's talk about being there for a good time, not a long time. Would you, when you think about picking an active fund manager, over what time horizon are you thinking about? So what I mean to say is, like, Platinum's been going for a very long time. Magellan, which you mentioned, also been going for quite a long time, not as long.
For both, I think 90s and then 2000s for Magellan.
Yeah, I think around the GFC was Magellan. Over what period do you kind of view that? Like GQG is probably like the new one that's in vogue at the moment.
You mean expect to hold?
So
review?
Obviously one of the benefits of an index fund is, well, in my opinion, you hold it for 50 plus years.
Yeah.
Which boggles the mind of most people. But there's no point holding it unless you're going to hold it for 5 to 10 years minimum, probably 10 years minimum. What about an active fund? Do you have a shorter time horizon?
I think any investment, any active investment, like your passive core will probably be, it doesn't mean you're going to keep that passive core in the same level.
Yeah.
And you might change that core to a different core. But any investment we look at, we're expecting at least 3 to 5 years, unless something significant changes. Yep. And part of that's the nature. If you're investing into direct shares, things change incredibly quickly, and you may not want to hold that business. And active management, we get a lot of questions, which is probably a good follow-on from this, is we're recommending a fund that has underperformed in the last 3 years. Why would you buy that fund now? And it is very much about what the conditions can change significantly, and the reason we use active managers is because they're specialised and they do something different to what the market's doing. So if they're no longer doing that, or the conditions aren't suited to that, it's generally changing within 3 to 5 years.
Okay.
But we'd love to hold active managers for 50 years as well.
Yeah.
The challenge there is that a lot of active management relies on one key person. So GQG, Magellan, Platinum, all a similar case. If that fund lasts 50 years, Kerr Nielsen or Hamish or Rajiv would be in their 90s by the time you finish, and you probably don't want them managing money in their 90s.
Yeah, it's a really interesting thing, and that just touching on that key person risk, because we use this word key person risk in finance quite a bit. And most people use it in any business, but most people buy the person. It's like politics. In Australia, you either resonate with Anthony Albanese or you don't.
Yeah.
And that's the reality. No one cares really about the other stuff, but that's the reality.
That's the way it works.
That's the way human nature is.
Yeah.
And that's why I don't think robo-advice works.
Yeah.
Because I believe for financial advice, you want to speak to a human.
It's empathy and trust that has to pass.
Yeah.
When you're giving up those sort of decisions.
So I've got millions of dollars and I want to speak to someone.
Yeah.
It's clear. It's simple as that. And even if they're not perfect, I want to speak to them. And I think the same with investment managers. You do buy the person and you do want the buck to stop with them. So when they do leave off, something happens and they falter, one, you've got them that you rely on. But if they step aside, like we've seen with some of those people you mentioned, it does mean that the brand is vulnerable overall.
You were in research once upon a time too, weren't you? Like research kind of is negative towards key person risk.
Oh, yeah.
But they're also negative towards turnover.
Yeah.
And it's like, how do you get, what's the perfect outcome? Is it just a complete democracy of investment decisions? But we know that in financial markets, a single person or direction, and you can't necessarily teach all of it, you can teach parts of it, that you do want some level of concentration. So when something happens, someone will make a decision whether that decision's right or wrong.
Well, if you look at the way we've built Rask, is that they had to start with an individual brand, which was my own. And then as the time has gone on, we've been able to launch a different podcast or a new channel or a new service. And a lot of the time on each of those podcasts, there's an individual that we are deliberately grooming.
Yeah.
Say Andrew Derrimouth in this case. We're deliberately grooming so that the individual brand stands alongside the overall brand.
Yeah.
And that's because of a fundamental belief that I have that people, while they think about risk management and a brand in that perspective, Amazon, you know that you're going to get your thing delivered. Otherwise, you'll just claim a refund. When it comes to personal interests, so things like medicine or things like health and finance, these real personal parts of your life, you want an individual. And that's very different to 20 or 30 years ago when the only thing that you saw when it comes to finance was Combank or NAB. And I think so much of the financial management industry, investment management industry is so far behind that curve. And that's why you see Platinum with Kerr, Hamish at Magellan work, is because they always stood out amongst these sea of predominantly blue brands, by the way. I don't know what it is with finance people and
light
blue.
No, never dark blue, light blue.
Like there must be the same consultant that goes through every startup investment company and be like, you know what you guys need? Light blue. Name it after a ship or a famous person that pioneered. And you're like, cool.
I think blue does it help with trust or it's calming?
I'm sure there's many theories.
Never read.
I'm sure there's many theories. Well, one of my other businesses I just went and copied the McDonald's colours because I thought automation sounds about right.
Yeah.
But, so there's theory.
And your colours are primary colours too, aren't they?
Primary colours. They will change this year, actually.
Yeah.
So, they will change this
light
year.
Blue.
Yeah, we're going to get light blue. Yeah, now we've moved into investment management. It's all light blue. It's going to right click and look at the hex code for Magellan. Just take that colour. No,
there's an interesting book. So you're talking about risk and how you perceive risk having less risk if you've got less key person risk. There's a book that a client sent me a few years ago, which is I think it's called Axioms of Risk. That talks about the opposite. And I think there's a question today about it as well, where if you're comfortable with it, we've talked about having 100% in equities, not recommending it.
Yep.
But there's a point where you can analyze yourself to the point that you won't take any risk, but you should just be accepting risk and, letting the ride, ride in the wave for an extended period of time, and you change your time frame. That was only one of the axioms in the book.
Okay,
it was more about accepting risk rather than trying to avoid and mitigate it at all costs.
Yeah, I think that's a common misconception, isn't it? It's like you flick the light switch on and off.
Yeah.
You got risk or no risk. It's not the way it works. I think we had Mr. Fogarty from Invesco on the show recently, Senior Secured Loans, and he talked about that he's not in the business of avoiding risk but managing it. And you make mistakes. And if we come back to that, the reason why I asked you about the active funds in portfolios is because I do believe that most of the really good fund managers have a lifespan or a half-life.
Yeah.
And I don't think it extends beyond 10 years.
10 years, yeah.
Yeah.
And size matters
in
that
absolutely,
as well. That if you get too big too quickly, then you can't be as nimble as you were before. And someone like GQG has done incredibly well because they've been nimble and shifted assets quickly. Now they're over 100 billion quite quickly.
Yeah, it's interesting. Like you look at all the really, really good investors over the last 10 years, they had a theme or a style that they focused on that worked really well in the conditions.
Yep.
Some don't adapt. Like obviously the extreme examples are like Buffett and Fundsmith and Chuck out of the US, like these guys
for an extended period of time.
Yeah, and they have a way of sticking to what's structural, but also riding the wave in 10-year periods. Yeah, and GQG's done that, but Magellan did that too when they moved into quality investing. That was Visa, MasterCard, Google. These businesses Hamish was talking about, Nick Griffin from Munro does the same thing. They have this time where they really collect assets and they really put on good performance. And I think if you're picking an active fund manager, I believe that you're looking for a shorter time horizon. But obviously time horizons, it's all relative.
And circumstances change. So we're adding, like to most clients at the moment, would be a mid-cap growth fund.
Aussie or global?
Global.
Right.
And the first question is it's underperformed by 4 or 5% per annum over the last 3 years, and for good reason. Like the Magnificent Seven has driven all the returns.
Yep.
But what we're saying, not that they're going to underperform, but the prospects for this group outside the Magnificent Seven to outperform is significantly higher over the next 3 to 5 years. So, and this is why they always say past performance is no indicator of future performance, but we all look at past performance anyway.
Yeah.
And a lot of our discussions with clients are around justifying that decision. And when you put in that framework, we want different. We want things that will perform if the Magnificent Seven doesn't. Just as not that we're all obsessed with that, but it's how do you have different levers to pull within a portfolio.
Well, people are getting concerned about the Magnificent Seven performing so well. Amazon, these types of businesses have done exceptionally well, and they've probably got a long way to run.
Yeah.
I noticed overnight my YouTube premium subscription has now gone up to $17. Ouch.
What's that, 12% increase?
Well, when I signed up maybe 3 years ago, it was $7.
Yeah.
So
what's that? 100% inflation in 5 years.
Yeah.
It's not bad.
And they've got some price to go. It will eventually flex out. Like I won't pay it forever. Definitely not.
Yeah.
YouTube is pretty powerful though. Of all of them, that's probably really powerful. But anyway, we should probably get to some questions. Oh no, I've got some hypotheticals for you. Go on.
I've got one for you as well. So your favourite brands are going global.
Which of those?
Smiggle.
Oh.
And Peter Alexander.
Oh, really?
Is that news this week?
But they were always testing that presence overseas, wasn't it? When they Smiggle was.
The Solomon Lew's Group Premier Investments, PMV, is now looking
ASX.
at spinning out Smiggle and Peter Alexander, just because they're growing so quickly. And like any business, the way you grow in retail is to just add more stores, and they seeing a massive opportunity overseas, and they think it's better funded and separated from the, let's call it the more mature businesses. I don't know why I did quotation marks, but that's Just Jeans and Suzanne. Is it Suzanne or Susan? I can't remember which one exactly. So
they got Just Jeans. They got Just Jeans.
Defensive businesses, and then some analysts are saying that they'll try and merge those mature businesses with Maya, which Solomon Lew also owns a significant share in, but freeing up capital to grow those, pretty recognisable brands in Australia now. Interesting.
Well, that's one of the things is it's a very well-worn path, isn't it, to spin off the high-performing brands?
Yeah. Extract value for shareholders.
And because they'll trade at a higher price-earnings ratio. It's a simple arithmetic.
Hope so.
Well, they would. You'd pay much more for Smiggle than you would for Just Jeans, wouldn't you?
For a while. Until it gets, saturation.
Oh, yeah,
this is their kind of traditional roll-up or store rollout strategy. And I mean, it's kind of exciting. We haven't seen a lot of corporate activity apart from takeovers of building materials companies in the last 6 or 12 months.
Yeah. Well, it also leaves them, by separating it also leaves them open to acquisition from US brands and these types of things. Yeah. So that would be really interesting.
Over under.
Oh, yes.
10% over under the NASDAQ year-to-date return.
I looked at this the other day. I should know this. I'm going to say over.
Yes.
Okay.
Over under 10%, S&P 500 return.
Over.
Under.
Really?
It was like 9.7
and
10.2 to be honest. I was stitching you up there.
And you've even got it in the notes here.
I thought you were going to look at them.
No.
That's amazing. So you've seen, everything was overvalued last year. I think you've seen, they said like a ridiculous rally, trillions and trillions of dollars in market cap created in the last 6 months. But markets are global, the biggest markets are up over 10% just in the 3 months of this year.
Yeah. Yeah. People get taller on average. Did you know that?
I very much know that when I play basketball.
But they do, right? They do. Just like the stock market. People are always amazed that, geez, the next generation looks tall. Yeah. But when the stock market goes up over time because companies get better and more profits created. Like if you look at
and other ones die.
Yeah, they do, yeah. If you look at the price earnings ratio of the NASDAQ on a forward basis, it's only trading like low 20s.
Yeah.
Which is not that high for those companies that are growing double digits. Like
because YouTube just keeps increasing.
YouTube just keeps increasing my fee, and I'm paying it. So, and that's not the big thing with that Magnificent Seven. The big thing with the Magnificent Seven is the cloud transition. All of those Magnificent Seven still haven't flexed on the rest of the world.
Yeah.
What that is going to mean, and those cloud computing companies that rely on those platforms, they're in for a very different 20 years.
A lot to come.
There's a lot of pricing squeeze to come there because no developer builds without it these days. There
was an interesting thing that came up too, which is, we do quarterly reviews for all our clients. So we're working through that at the moment. They'll start preparing next week. But I think it was in Bloomberg today, they were talking about how because global US equities have performed so well, there's going to have to be, they could be 4 or 5% overweight in asset allocation. So there could be, not saying the market's going to fall, but everyone will say the market's going to fall.
I've been getting that one lately.
Yeah, flow of capital from US equities back into US bonds as, pension funds and investors have to rebalance portfolios every quarter. It usually doesn't have that much of a impact on the market as far as I've seen. And then more importantly, you're going to another earnings season in the US in the next 3 weeks.
Yeah, I mean,
we'll be looking at the same in ours.
Journalists got a journal, right? And but what I mean is about that, I think it's a valid point, but
I think it's in their calendar for March every year. If the market's falling, they're going to say we need to top up US equities. If the market's rising, we need to.
But the US market has been dominant. And I think you mentioned it before. One of the things you're going to look to do with the Waddle clients, by the sounds of it, is you're adding that mid-cap global so you can deflect some of that mega-cap focus. And that's an example of what people should be thinking about right now. In my opinion, I think that too. And a lot of people listening to the show have witnessed 20 years of the NASDAQ being unbelievable. No reason that it won't continue to do that. But and by choosing the NASDAQ over the S&P 500 or MSCI All World, you've captured more of that.
Yeah.
But that doesn't necessarily mean that the next generation of companies is going to be the same generation, so the same type of company. So I don't know about you, but I prefer the S&P 500 over the NASDAQ. Sure, have some exposure to those companies and have some NASDAQ in your portfolio, but the S&P 500 is my preferred exposure.
Same, and we kind of prefer the MSCI, so the MSCI Global, which has a bit more European.
Yeah, you get 20%
flavour
European.
in there.
Yeah, you get a little bit of Japan and that sort of stuff in there.
I think it reiterates the importance of rebalancing or at least reviewing your portfolio quarterly.
Yeah.
So a lot of clients, a lot of investors, a lot of advisors only do it once or twice a year. And it doesn't mean you have to do anything, but at least check where you sit against your objectives, review your performance. We know it's really hard for retail or for normal investors to have.
It's a question on that, actually.
Really understand their performance from various asset classes. But it's like the perfect time to do it. And it looks like another 12-month period of strong returns.
What about, I'm just interested, when you do those quarterly reviews for Waddle clients, what do you actually do? What's in there? I've seen one of them because as you know, my in-laws are clients of Waddle. Obviously, you're their financial advisor.
You signed an NDA?
Yeah, NDA. No. Yeah. They gave me all this special sauce. Drew said this. But no, seriously, so it's like a update, because the reason I ask this is because I've been speaking to a lot of investors lately, and many of them have been disappointed with their financial advisor. Yeah. And that happens. It's an emotional thing. Different financial advisors behave in different ways.
Advisors can be generalists as well, not necessarily investment focused.
Or retirement
we're
focused.
A group that has very big investment focused.
Yeah. So what would the standard be?
So we essentially try and replicate what a professional or institutional investor will do. So every quarter we have an investment committee meeting, and the investment committee meeting, the outcome of that is essentially what comes into the quarterly review. So it's only investment focused. We do strategy and SOA reviews every 6 or 12 months separately to that. But the first thing we always look at, one, what's the performance been? What's the asset allocation look like? The strategic asset allocation, which is your long term where we think you should be sitting, and then the short term where we are according to that. We can look at very closely and try to consider the macro environment. So what's happening to oil, what's happening to the economy, what's happening to interest rates, think about all those inputs. It's not Andrew Dermott trying to predict what's going to happen, but being aware of that, because that tells you maybe you should have more in smaller companies or value or growth. And then it tracks everything. So we report on internal, like a performance for 3, 6, 12 months, 3 years. We look at, show you how much income and franking credits you've received, where your exposures are, an update on every single investment you hold in your portfolio, and then
like a table that summarizes it or something.
Yeah, but a couple of dot points on each investment and their performance, and then any recommended changes. So if we're recommending changing the asset allocation, we'll explain why, and if we're recommending changing an investment, we'll give you a very detailed write-up of the benefits and why we're adding that.
Okay.
Yeah.
It is really important for a lot of folks, but a lot of people aren't familiar with what would be included in one of those. And
I've been trying to find a tool that we could use to do it rather than, because it's like a 20-page document delivered digitally. But how do you show that in a simple tool or a simple image? It's quite difficult.
Yeah, fair enough. So one of the hypothetical questions I had for you is getting a lot of, actually I'll focus not on the yield question right now, Drew, but on this other question is I get a lot of people talking to me, and even just at a 60th on the weekend, I was talking to some folks of that ilk who have investment properties, and obviously being in Victoria, they're outraged by the litany of,
laughing at that. It's crazy.
The litany of different taxes and these types of things that are now applying to property investors. It's obviously very political, and it seems to be only going one way.
Yeah.
You can wake up every day and there's more unusual policies being proposed by some quack that sits in a big house in Canberra. But like I wanted to give you a very simple example, like a hypothetical situation. So imagine someone that's in their 50s, they've got 2 investment properties, they got say $1 million of debt.
Limited other investments?
Basic, like limited super balance, limited investments outside. Like they got cash and all that sort of stuff. Don't assume that sort of stuff. Don't worry about that. They got 1.5 million of equity. So 1.5 million equity, but they've still got debt attached to those 2 properties.
So they've got $2.5 million.
And their PPOR, primary residence, is mostly paid off. Yeah. How would you think about someone that's like thinking, got all these taxes, I'm going way behind with my property, prices, I don't know where they're going. What would you do? They got 10 years till retirement.
I think one of the big reasons people have borrowed and done well out of, or why they borrowed money and gone into property is that the long-term capital growth has been exceptional, and they've been willing to give up income in the meantime for that. So, a good yield on property in Melbourne has been like 3 or 4%.
Yeah,
like that's a good yield.
Yeah, that's very good.
And that was before interest rates. That was when interest rates were at 3%. But what we're seeing, and I'm probably answering the question the wrong way, we've seen a lot of people with this situation come to us telling us they want to sell their property. So the yield that, giving up that yield for a long period of time, now that yield has fallen from 3 or 4 to 1% or less than 1%. Land tax has tripled. Repayments have tripled. In some cases, your interest-only mortgage has turned into a principal and interest, and your repayments have doubled or more. And servicing these, I think people are getting less patient and less positive about the outlook for property prices. I think you're still going to have that trend of reasonably strong property prices because of a lack of supply. But we're seeing more and more people selling at least one property to pay off the majority of the debt and then freeing themselves. And we see this as this opportunity to have more flexibility. If you've got debt and you've got big repayments, you've got all these other and unexpected expenses that come out of property, it's giving you flexibility to consider other things. So a lot of selling a property and then looking to sell the other one as they get closer to retirement or in retirement, and shifting towards more liquid things they can sell. They say you can't sell a brick or you can't sell a bathtub.
Yeah.
But at the same time, you can go from a property yielding you 1% and costing you 3% to a government bond or a term deposit gives you 4.5%. Yeah, you'd get no growth, but it sounds a lot more straightforward and less stressful in this environment anyway. So my answer is most people coming us wanting to sell.
Yeah.
And just generally at 50, you're starting to, superannuation is becoming quite attractive. So it's time to start thinking about how you split your assets between direct, illiquid property and similar things into more diversified other asset classes, like anything, even shares are paying you 4.5%.
Yeah. I've got a follow-up question to this, but one final one before we get to everyone's questions. The one thing that people should be aware of if you're over the age of 55 is a downsizer super contribution, which is up to $300,000 per person and does not count towards your contribution limits.
Your non-concessional, outside your non-concessional cap.
Yeah. So you can juice your super if there's 2 of you with $600,000 or 1 with $300,000 if you are over 55. You've got to be aware of like the balance transfer cap. That's the upper limit that we often talk about on the show.
In pension phase,
Yeah. But the reality is that's a massive free kick for people that are looking to make a contribution, as well as the increase in concessional contributions up to $30,000 from 1 July 2024. So these are ways to boot that higher. The follow-up question is this, I'm getting a lot of questions on this, and what would be reasonable if someone is looking to make that transition, or just in general, as we sit here in late March 2024, what would be reasonable in terms of income from a balanced portfolio? 50-50.
So if we break this down and you think you 50-50, so you get 25% in floating rate fixed income, 25% in fixed rate fixed income, you're probably expecting a return of something like 5% from that portion. This is going to be a very simple calculation. It could even be more than that. It could be, if you think about what's in floating rate hybrids, you're getting 6 or 7% from those. So let's say it's actually 6% in your fixed income allocation, which sounds really high, but it's actually achievable. And then you go over to your equities and your domestic shares, which are yielding about 4%. or maybe 4.5, 5 with franking. Your global equities are probably more like 2. And then your real assets, something like probably 4. So let's say you're getting 4% from your growth, 6% from your fixed income. Used to be the opposite. I think you can expect, and we know from our work, you can expect to generate an income about 5%, but particularly in Australia where you get that franking credit free kick. Yeah, I could have just said 5% rather than go through that calculation.
No, it's good because people need to know how those different components add up.
Yeah, exactly. We can do it in a bit more detail next time, but I think there's never been a better time to be trying to generate a passive income from a portfolio of assets than now, compared to any time probably in the last 10 years.
That's why I included that question in that order, because I think people for the last 20 years have been so obsessed with property and finally the light bulbs come on that there's so much better opportunities in the stock market and in bonds, in term deposits.
It doesn't mean property's going to do badly.
No, it doesn't.
It's always going to be somewhat supported. You can tell by immigration and the growth in the country. But expecting 10% growth every year from properties, which is
on
what
leverage,
every single person has come in expecting.
Yeah. I think if you're older, so 50 plus, now is the time to transition out of most of the property. That's just my general, obviously case by case would vary, but generally speaking, and I'm buttering my own bread here. Of course I'm biased here, but now is the time to transition out for the yield and for the stability and flexibility that people could have. I think it just makes so much sense, especially if you're in that 50, 60 demographic. You want to be contributing as much as you can, and you can't just go down to your property and then put it in your super fund. You've got to make change for that to happen. So anyway, let's get to some questions. The first question, actually, no, I've got to do the disclaimer. Quick disclaimer. We don't know your personal circumstances, needs, goals, objectives. So make sure you speak to a financial planner, like say Drew here at Wattle Partners, or you can head to the link in your show notes that says financial planning. Click on that and you'll get matched with the financial planner. You can head to the moneysmart.gov.au website to check that the financial advisor is actually registered. Never, ever trust someone that does not operate under an AFSL. And I mean that, ever. Always read the product disclosure statement of every super fund, ETF, whatever we mention, because that can give you information before you decide to invest or acquire that financial product. And obviously, if you don't know what your needs, goals, objectives are, best to speak to a financial planner or financial advisor. There is a difference, but that we just lump them in together. When I say there's a difference, different in skill set, but they're both licensed. First question comes from, need some good IT guidance. And this is more of a portfolio administration question. Hi guys, looking for a platform I can use to link all of my investment portfolio feeds. We have a trust, a company, an SMSF. They will all produce tax reporting without going through it, and they want to produce tax reporting that you can use without going through a financial advisor who wants to charge this person $40,000 a year, Drew, and wants to manage it by themselves instead. The current advisor has us on Class, which is a software that's typically only reserved for financial advisor.
And accountants mainly.
Yeah, accountants. They've tried Hub24, but they can't get onto it without a financial advisor, which is very frustrating. They say, have been investing for years, so I'm capable of taking on the task myself, but finding it difficult to find the right tools. There are many options, but not many that do everything. ShareSite is probably the best bet. That's not a financial product, so I can make that mention.
They don't do tax reporting though, do they?
No, they do, yeah.
But not audited tax reporting.
Not audited tax reporting, but they do...
Like estimates of your distributions.
They do everything. So in that sense, they can do ASX, global shares. They can do managed funds because they've got API codes.
Yeah.
They can do investment property. You can track it through there and you can get a consolidated view of your performance and your tax.
Yeah.
And they produce a tax report, but they don't do the audit.
And your accountant would probably still want to...
some
of the supporting documents.
For the SMSF, you definitely want the accountant still.
It's a great question because I don't think there are any. And the reason why the tax reporting is different on Hub24 and Net Wealth and those systems is because they take custody, like they're custodians, and they can actually give you an audited report that can go straight to your accountant, whereas most of these will need supporting documents.
Yep.
So in that case, you don't have to give the dividend statement as well as a tax report. That's why I was kind of loaded question. I actually don't know one, and this sounds like someone I spoke to this week. That Class is actually a tool for accountants to administer SMSFs and administer super funds. So using that as the kind of data source I haven't seen on its own before. We have plenty of tools. So we use X-Plan or Iris, but that's only available to financial advisors.
Yeah.
And then all bank accounts, platforms, everything comes into that. So, yeah, I actually don't. I think ShareSite's about the only one I know of that's similar, and very few can do any really great tax reporting as far as I've seen.
Yeah, Navex is more for share portfolios, SMSFs, that sort of stuff. This is, I won't reveal names or anything.
Excel spreadsheet. But
in the Rask Invest platform, we actually use one of those fancy reporting softwares on the back end. I won't say who because it's a commercial thing, but we get access to that because of what we've built.
Yeah.
And so people get that reporting, but they're not aware where it comes from because it's all white labeled.
Yeah.
So that's what we offer, that same feed in through an API, but it's not a complete holistic view. What we're actually working on in the background, and I can say this but it won't reveal details. What we're working on is, even though people may invest with us, they will soon, we hope, be able to track every investment through the one account.
Excellent.
So
I'll find out what it is off air.
Yes. Yeah. So they would be able to enter their HIN number or whatever, and it would automatically pull in all the data from the third party source, and it would be available direct to investor. But it's we can chat off air more about that. But in the meantime, need some good IT. ShareSite is a good one. Compare that with Navexa. You will have to create separate accounts. You'll still need an accountant to verify things. Now, this is an interesting one, more stock related, not another Munger pun. Drew and Owen, what are your personal thoughts / opinions on the ASX listed company Brickworks? The ticker symbol is BKW. Drew.
I don't know a lot about Brickworks, to be honest.
Okay.
I know it's a well-managed business and it's got a partnership with Soul, or a cross-ownership with Soul Patts.
Yep.
From memory, Brickworks, Soul Patts is the listed investment company and Brickworks is the one that owns bricks.
Yep, Austral Bricks.
Yeah, and you've seen massive amount of interest in that kind of sector in the last 6-12 months. So Boral has been taken over by cement and similar products. Fletcher's done reasonably well. CSR has had a takeover from a French group as well. So I know it's incredibly well run, and it's in a sector that's set to benefit from, we know there's a shortage of housing supply in Australia, so it's set to benefit from more construction, more residential construction. And I love nothing more than a traditional brick house.
We had Lindsay Partridge, the CEO of Brickworks, on the show a couple of years ago now. I was in the middle of a reno, so recorded it in basically an empty house. And he said, it's funny the way he speaks. He's really passionate and I love it. It was funny because he said, is there nothing more beautiful than a brick? And I just thought that was just a really odd thing to say, but I get it.
I've just been seeing some recycled brick houses and they just look beautiful.
Oh, they're the red bricks. Do you know how expensive they are? $2 a red clinker. That's unreal.
We've got some in here.
30 years ago, they just throw them in the ground.
Yeah.
Well, we had to get some for a retaining wall we did. Gosh, that's expensive. But anyway, bricks aside, Brickworks as a business is actually, it's not a monopoly, but it's a very powerful business in terms of brick supply throughout Australia. You've got businesses like Abri, Adelaide Brighton Cement.
Yeah, also taken over.
Yeah, these types of businesses. But what some people don't know behind the scenes is that Abri was mostly cement blocks. Yeah. That's where they did most of their work. So like up north, Adelaide, these types of places where you get a lot of block work. But in terms of retail-facing bricks, Austral is the dominant player.
Yeah.
Austral, sorry, is the dominant. Austral? I keep on getting it wrong. Two different companies. It's dominant. And they actually built some of the bricks for the other players in the game, because they're so efficient at what they do. So it's actually a wonderful operating business. But one of the secret sources of Brickworks is actually that it uses its land to its advantage. And this is a very common strategy amongst some of the big blue chip type companies, like Wesfarmers and so on and so forth. But what Brickworks actually do, and you've probably got one of these brick factories, the kilns near you, and you don't really know, but they actually strategically buy land 20 or 30 years in advance.
Yeah.
So in Victoria, there's a big one out northeast, where that's along the Hume Freeway that's getting developed out. They've done the same thing overseas. I think they're more like around northeast America. And what they've done in eastern Victoria or all around Australia is they put these gigantic brick factories, if I can say that correctly, and then what they do is they operate the business on top, and effectively it's just like paying down an investment property mortgage.
Yeah.
After 20 or 30 years, they've got this huge land bank, and then they sell that for a huge profit.
Private equity loves that.
A huge profit. It gets developed by
Real asset
Metricon
backing.
or whoever. And then they move on to the next site and build the new factory. And it's a wonderful business model if you take a 10 or 20 year horizon. You're right, Drew, in that 43% of Brickworks is owned by Soul Patts. Soul Patts is about 2.5 times the size. But Brickworks owns 26% of Soul Patts. So Soul Patts owns over 40% of Brickworks because it's a bigger business, as in Soul Patts is. But the other way around, Brickworks only owns about 26%.
Yeah.
And that's my numbers. I believe that's correct. Yes. Now, this is really interesting because some people say, well, would you buy Brickworks or would you buy Soul Patts? I'd buy Soul Patts because Soul Patts is more diversified. It has, even though you said listed investment company, it does have some fully owned private businesses, but it is a bit more diversified than Brickworks.
Yeah.
I'd happily own both, and I probably wouldn't own them both if I was thinking they were separate businesses because they basically are joined at the hip.
You're getting a 40% allocation anyway.
The Milner family is common across both businesses. I think two of the best run diversified businesses in Australia.
Yeah.
Would I buy them at today's prices? Well, maybe, but a small allocation. Brickworks currently looks more expensive on a normalised basis, but a year ago, it could have been a normalised basis. The reason why I use normalised earnings for these two businesses, particularly for Soul Patts, some people would know this, is when you go into basically the way the accounting works is that because Soul Patts has a lot of unlisted assets, they have a lot of publicly listed assets. What they have to do is they have to mark those investments to give a realised impression or like as if they were marking it up or down for the value of that. And that goes through the income statement, which means that 1 year their actual reported profit can be 400% higher. The next year it can be 100% down. Yeah. And this year we've seen it 100% down.
Write-downs.
Yeah. So you want to make sure when you look at the business, you look at the free cash flow yield or the just the dividend yield. That's a better valuation metric.
Yeah, definitely.
So those two businesses I think are wonderful. I would go Soul Patts.
Soul Patts is super interesting. I think they own part of Ironbark.
Yes, they do.
Well.
Yeah, they
so
own
like distribution,
Pendle.
Marketing.
Yeah.
And a few, and there's some lending businesses they do in there.
Yes, they got structured yield. Yeah.
Similar way to West Farmers. I'd kind of think that they're allocating capital to different types of businesses. They're just more listed and
the types of businesses that don't serve a sausage and bread, so you don't know that they exist, but they do.
Yeah,
and that's the core difference. And one of the things that when we spoke to Todd Barlow on the show, CEO of Soul Patts, not too long ago, one of the things that he pointed out is that for many years, Soul Patts has only invested its balance sheet. So meaning that whatever money it generates from like TPG Telecom paying it a dividend, it invests.
Yeah.
But in the future, what will likely happen is you mentioned Ironbark, I mentioned Pendle, these types of businesses. What will happen in the future is most likely it will transition into outside investment coming into it as well, which gives it leverage. So meaning that if they're a really good investment company, why would you not just invest with them?
Yeah.
Sure, you can own the stock, but why would you not invest with them? And that's probably the
co-investments
the next big leg for Soul Patts. And I think that's going to, next 20 years is going to be the predominant driver of the earnings.
Yeah.
Good question. So the next one, and this was more of a topical thing. We've probably run a bit over time, Drew, but we'll go with a few more. By the way, if you do get a question aired on the show, send us an email because we do record your address. You give it to us, and you get 2 copies of Drew's new book, The Golden Years. How to not F it up. No, what's wrong with that?
How to live a successful and enjoyable retirement.
Okay, we'll work on that, guys. But
investment and not just everything financial, both parts of it. We're just trying to. I was doing an interview with Nick in our office, who's writing an article for the Golden Times publication.
Yep.
And it was very much about improving or adding a resource. There seems to be very few resources that help retirement-related financial literacy.
Yep.
Like people generally younger cohorts listen to the podcast and are more engaged, whereas the resource available to people 60 plus to understand retirement are very limited.
Yeah. Yeah, that's why they listen to the Australian Investors Podcast.
Yep.
And they will pick up a copy of your book, The Golden Years, by asking a question and getting their question featured on the show.
You get signing every copy.
You get 2 copies sent to you. So you get your questions in now. There's a big box of these books sitting in the office, ready to be sent out to you in the next few weeks once we get the go ahead. Bitcoin Mogul writes in and says, I've been investing in ETFs for a while through ComSec Pocket and Self-Wealth. Good on you. Thanks to Rask YouTube channel. Okay. However, I see other services like InvestSmart, Pearl, Rask Invest, etc., which do something similar. Just wanted to understand under what situations one might want to use these platforms instead of buying ETFs like VDHG themselves. I'm going to take this question and spin it, Drew, and I'm going to ask you good and bad, pros and cons of VDHG or the diversified ETFs.
Yeah, I mean, they're very simple that and it depends on.
It depends.
I didn't even do that one on purpose. It wasn't even planned.
We need to give like a little thing. There we go.
You can just get me on a loop. It depends.
We'll just come out with an episode that's just recorded every time you've said.
I think it depends who you are. Like if you're a young person and you're completely comfortable knowing that if you're in VDHG, you're going to get whatever happens to the market for the next 30 years and you're going to keep putting money into it. As you said, you could probably hold it for 50 years. But from my perspective, if you're someone who's now not just retired, but starting to think about generating a passive income from their capital, or is a bit more concerned and more attuned to volatility and more likely to react and be emotional when things happen. I think naturally you want to start adding diversification. The problem with these, and they're not bad products, is that they simply own. This will own the MSCI. This will own the ASX 200. So straight away you've got like 30% of your portfolio in US shares, 30% in Australian shares, and that's basically in technology, mining, and banking. Yep. So you're not truly diversified, and your portfolio and your returns will work when markets are going up, but when things change, when pandemics hit, when all kinds of events happen, they're not going to be cushioned at all from that fall. So we like, as you know, we like active. This is a passive strategy. We like passive and active, and we like active because it can smooth the ride. Actually, one of the golden rules.
That's a chapter in the book. Don't worry about getting the book now.
Yeah. And it gets worse. I think it's a different case for this one because you're just buying long equities. When you get to like the balanced growth or the balanced, the ones that include bonds as well. There's another question today, whether we get to it or not, which is I've made negative returns on my bonds. Why would I hold bonds anymore? And this is a similar problem that you have with these, set and forget asset allocation strategies that you didn't want to be holding fixed rate bonds 5 years ago when interest rates were zero, or 3 years ago when interest rates were zero. But this strategy is forced to because that's what's in the benchmark. Yep. So they're not able to adjust to changing conditions like we've seen in the past. So again, if Magnificent Seven don't do well in the next 5 years, this thing won't do particularly well.
It's interesting that
still like Vanguard, and BlackRock.
The way you concluded there, which is probably where I was going to go with this. Firstly, I think they're great for new investors. When they were launched as ETFs, they've been around for a long time as managed funds. But let me just tell you what this is first of all. So VDHG, for those of you that don't know, Vanguard Diversified High Growth. There's Vanguard Diversified Balance. There's Vanguard Diversified Conservative, and basically what it is an ETF of managed funds. So you just invest in the ETF, and then it splits your money up behind the scenes into different different managed funds, and you'll have a bit of shares, a bit of this, a bit of that, as Drew said. For VDHG, it's the most popular because it's most popular amongst younger people because they get 90% in growth assets and 10% in defensive assets. The final point you made, I think, Drew, is the most salient point, and I think it's the thing that most people miss. The
rest was bluster.
No. I think all of those things are relevant, what you said, but that final point, which is the flexibility of it, is just simply not there. And I'm going to give you an example, is that 3 years ago, you could have invested in something like this or the balance strategies, which was more pronounced, and you would have got a big chunk of your portfolio just in bonds. Yeah. And at the time, even your monkey's uncle was saying, don't invest in bonds. And these things, because they're the ETF and the way they're built is that once they're in motion, they have to stay in motion, that old law. As in, if you create an ETF, you have to stick to the rules that are set in that PDS. Whereas a financial advisor or a platform that you manage yourself, you can tinker, you can move things. You're not bound by the rules of the ETF, but an ETF must do what it says.
The asset allocation is fixed.
Yeah, so you're like running towards the wall and you cannot stop before you hit it. You have to run into the wall
because that's do a U-turn.
Yeah, that's it. You can go, oh, that's not going to work. I'm going to this way. And that was really obvious a few years ago when all of these investment funds were long duration bonds, meaning that they have government bonds, but when the central banks put the interest rates to zero, the only way interest rates could go up is up, which means the only way the bonds could go is down. So effectively, you don't have any flexibility. When we had Balaji on the show from Vanguard not too long ago, he did say that they may be looking at making those. This is an ETF of managed funds.
Yeah.
He mentioned that they might make it an ETF of ETFs if they can do that. The reason why I believe is because if they made it an ETF of ETF, people could then go into the Vanguard platform or into their broker and say, I want this broken up and I'm going to sell part of it.
Yeah.
So they could do what's called an in-specie transfer. It's a bit technical. I'm getting way into the weeds here. But basically, these are good for new investors, I think.
To get exposure.
I wouldn't, if you have a meaningful balance, I wouldn't use them.
Yeah.
That's my view.
We just generally break these down and run the asset allocation ourselves.
Yeah.
That we still hold an ETF or a low-cost product at the core, and then add things around it. And part of that reason is what happened with bonds. You could still hold bonds, just not the bonds that are in an index.
Who was the person that said things should be simple but no simpler?
Not me.
But basically, you want a simple investment strategy, but not so simple that you run into errors.
Yeah.
So, for example, if you're in your 40s and you're thinking about VDHG and you're thinking, this is my one and only baby, I'm going to ride this thing until retirement. You may end up in retirement or near retirement and go, holy heck, I need to get more income.
Yeah.
And what do you do if you've got $1 million in VDHG alone? At the moment, you don't have a choice. You just have to sell it, which is going to incur tax.
Okay. Yeah, exactly.
Whereas you could have been rebalancing along the way and that sort of a thing. Okay, Drew, what was the question you just mentioned before?
I was talking about
we've probably got time for that.
Ozymandias.
Oh, Ozymandias, okay.
It was more a portion of, maybe I can break that in just to one portion of that question.
Yeah, there was a big question here from Ozymandias. I think that's how you say it. I have made it through the GFC and got rid of a large margin loan. At the time, I am interested in the rationale of true diversification and I don't like bonds. And I've actually lost more money in commercial bonds as I have in shares and have lost on the bond ETFs compared to shares. I'm a committed long-term investor, so I ask, why shouldn't I be aiming for long-term growth rather than going conservative with low dividend cash, with low yielding cash and bonds? I accept the volatility of the share market. Could you pick apart my logic? A lot of people think this. Let's generalize this. A lot of people think, why do I need bonds?
And the data that's shown, if you just go 100% equities and your time frame is long enough, you'll be fine.
Happy days.
But in the real world, people generally can't, we say we can accept the volatility, but we've said here that we don't like the volatility in the question, say I'm not comfortable that things have fallen. Well, that's not really taking the long-term approach. I think in my experience, most people can't accept the level of volatility that comes with being 100% in equities, and they ultimately end up making emotional decisions that end up being bad decisions or mistakes. And once you're in retirement, those losses that destruct your capital are more punishing than they are at any other time. I think the biggest story, which is what we just mentioned, is that most informed or advised, I hope most advised investors weren't increasing or holding large allocations to fixed rate bonds in the last 3 years, or when interest rates were near zero. It was pretty clear to most investors that had flexibility. The other part is not every investor, so even industry super funds don't have the flexibility to sell out all their bonds either. That's why they also struggled. I think it's the change in conditions in terms of bonds wasn't foreseen, and it's actually changed. We're more on the view now that why would you take more risk than you need to deliver the same level of return that you probably got over the last 10 years? So is it possible to get the same level of return with a lower risk rather than having to accept the volatility that you're talking about?
Yeah. Okay. I like it.
I think I turned that question around halfway through.
No, I think people's risk profiles can change through time as well.
Yeah, 100%.
And a big part of, in my opinion, a risk profile should be how interested are you?
Yeah.
If you're more engaged with your portfolio, as maybe this person is, you can probably afford to add some complexity. But if you're, like we see this a lot, people late 50s to say late 60s in that, no offense everyone, but you're particularly prone to this, where you will not be that interested in investing and finance, and all of a sudden you realize you're about to say goodbye to your income and you're dependent on your portfolio. And then you go from not really caring, just kind of letting someone else do it or your super fund, and then all of a sudden you're too hands-on.
Yep.
And you go, I need to get into the weeds on this and I'm going to do this, this and this. And then all of a sudden you hit retirement, a few years goes past, you're more interested in going the Azamara cruise around Greece, I would be too, than actually worrying about this stuff. So you either need a financial advisor who's going to stick with you, or you need to start diversifying and educating yourself on that and knowing that sometimes you can be your worst enemy around that time of life. And the reason I mention this is because some people's priorities will change. And then later on in life, you probably want to hand investments to your kids. You don't want to hand them something that's not suitable for them either. So start thinking about all of those things that could happen in advance. Bonds, I agree, from a purely mathematical perspective, don't make a lot of sense. Like if you take a 50-year view.
Yeah.
But at the same time, you should have some allocation across defensive investments so that you can top up on the growth investments when they fall, because they will fall.
Diversification, and it's about managing
even
emotions and risk.
Cash is good right now.
Cash, but I find clients generally at worst with cash because they think they need to spend it or invest it, and you get the opposite problem. Yeah, but bonds, property, real assets, infrastructure, all these things that perform differently to shares.
Some private credit.
Because we know it's not going to be, it's not smooth. It's not 10% every year. It's 31 year, negative 10 the next. So having something that isn't, subject to the same experience as that can help in making better decisions, and then helping, some of the biggest returns we've generated is when we do quarterly reviews for clients and have the ability to rebalance. But you can only do that if there's no point selling a stock that's fallen 20 to buy a stock that's fallen 20. You need to sell something that hasn't fallen to get the benefit of that discount.
True that. You need to come up with a joke. I'm going to say you can get in contact with Drew at wattlepartners.com.au. You can send me an email, get in contact with me in numerous ways. There's all links in the show notes. I do have to pick the best question to name. You win the Value Investor Program on Rask Education, which is my complete course that takes you through all different types of investing, ETFs, portfolio management, but also value investing and getting really into the weeds of discounted cash flow and all those things. I think the question and name that we didn't get the answer to their question was the Asset Alchemist. Love that because I've been reading the Alchemist book lately. It is wonderful.
Me too.
Yeah, it's wonderful.
Great book.
So the Asset Alchemist, if you did write in, you had a question about Whitehaven Coal we didn't get to today. You win the Value Investor Prize. So send us an email just saying that was you. And everyone else, you will get a copy of Drew's book, but you do need to write into us and tell us who you are and give us your address in the email.
Quite a few emails with that too.
Okay, good.
I've been forwarding them to you. I want you to.
Okay. So send them in. If you did ask a question recently, send us it soon because we're going to be posting them out soon. Don't delay. All right, Drew, give us your dad joke.
All right. I'm just really stretching this one. You probably saw on camera I was trying to find a joke pretty quickly.
Yep.
Here we go. I think Monique's going to love this one. I thought I would tell you a good time travel joke, but you didn't like it.
See what you did there? That's nice, mate. It had me about as lost as I was in Tenet, which is that
what I was aiming for.
That was good fun. So, well, let us know what you think of Drew's jokes and maybe try and help him out next week's episode. We'll see you next Saturday morning, either on YouTube or on anywhere you get your podcast. Don't forget to subscribe. We love hearing from you too. So write in your questions, hit that Ask a Question link, and we'll see you next week. Drew, thanks for joining us.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.
Hi, I'm Drew Meredith, and this is the source of all my dad jokes.